Let's jump right in. Today, in this explainer, we're unpacking a portfolio that is so fiercely concentrated, it basically shatters conventional Wall Street wisdom. We're talking about Duan Yongping, a guy often referred to as the Chinese Warren Buffett. He's the mastermind running a massive $17 billion institutional vehicle called H&H International Investment. And what we're really digging into today is how exactly he uses extreme concentration to build and maintain wealth. So, if you're used to the old advice of spreading your money around, well, get ready for a serious paradigm shift. To really get a feel for the man behind the money, you just have to look at this one number right here, 600 grand. Back in 2006, Duan paid over $600,000 at a charity auction for one very specific thing, a lunch with his absolute idol, Warren Buffett. And this isn't just a fun little piece of trivia. It proves his absolute, uncompromising dedication to the philosophy of value investing. He doesn't just read about the market greats, he literally pays a premium to sit down and internalize their mindset. So here's our quick roadmap for today. First, the Chinese Warren Buffett. Second, concentration versus diversification. Third, the safe called Apple. Fourth, the leap into artificial intelligence. And finally, how to manage volatility. All right, Section 1, concentration versus diversification. This is where Duan actively goes to war with standard financial advice. He's completely unapologetic about it, saying diversification is for those who don't know what they are doing. Just think about that for a second. Most advisors out there preach diversification as the absolute golden rule of risk management, right? But Duan, he basically views it as a hedge against your own ignorance. His logic is, if you truly understand a business inside and out, why on earth would you put your hard-earned capital into your 20th best idea when you could just load up on your top 3? So you have this huge contrast between the two mentalities. Traditional management relies on dozens, sometimes even hundreds of stocks spread across every sector just to artificially mitigate risk. The Duan method, on the other hand, is hyper-concentrated. Out of a $17 billion portfolio, he holds just 11 to 14 total positions. That's it. And they are strictly confined to a circle of competence: tech, e-commerce, consumer electronics, and a few major financial holdings. He only plays the game where he knows for a fact he has an overwhelming edge. So how does he pick those very few winners? Well, he uses what you could call the Apple and Buffett model checklist. He relentlessly searches for unshakable defensive moats, iconic brands that completely dominate consumer mindshare, and truly excellent management teams. Because, let's be real, extreme concentration only works and only keeps you from financial ruin if the underlying businesses are practically indestructible. Moving on to Section 2, the safe, called Apple. Brace yourself for this one, because seeing how his theory translates into actual allocated dollars is kind of staggering. We're looking at roughly half, about 50.3% of a $17 billion portfolio sitting in exactly one single stock: Apple. The entire rest of his global investments combined makes up the other half. It's a level of conviction that is almost unheard of when you're dealing with this massive scale of institutional capital. But why Apple, right? Well, Duan has a really unique perspective here. He doesn't view Apple as a hardware company that just sells phones and laptops. He sees it as this massive consumer goods ecosystem with unparalleled customer loyalty. When you add in the immense, consistent free cash flow and their incredibly aggressive share buyback program, to Duan, Apple isn't some volatile tech stock. It's the ultimate safe. It's literally a financial fortress where he can securely park billions of dollars. Looking at the rest of that safe, right below Apple is Berkshire Hathaway at over 20%. Buying Berkshire is essentially his way of owning premium American economic infrastructure, managed by the greatest capital allocators alive. But check out number 4, PDD Holdings, the parent company of Pinduoduo and Temu, sitting at 7.5%. And get this, PDD was founded by Colin Huang. Colin Huang is actually the young protege that Duan brought with him to that $600,000 lunch with Warren Buffett. I mean, that is the circle of competence in action right there. Let's jump to Section 3, the leap into artificial intelligence. Because even the most disciplined, historically minded value investor has to adapt to massive technological waves. And this number is just wild, 1,100%. That's how much Duan recently increased his position in Nvidia. This wasn't just dipping a toe in the water to test out a new sector. This was a massive cannonball straight into the deep end, instantly transforming Nvidia into the third largest pillar of his entire multi-billion-dollar fund. To fund this really aggressive shift, he actually trimmed a tiny bit off his massive Apple anchor position. He then heavily boosted Nvidia, increased his Microsoft holdings to capture enterprise cloud value, and made some very targeted bets in specialized AI infrastructure players like CoreWeave and Tempest AI. For Duan, artificial intelligence isn't just a fleeting tech trend. He's looking at the build-out of AI infrastructure as a structural paradigm shift. To him, it's a wealth generation event easily on par with the 1990s internet boom. Which leads us to Section 4, How to Manage Volatility. Because all this extreme concentration and aggressive reallocation brings up the absolute elephant in the room, the classic sleep test. The math of compounding returns is great and all, but the daily psychology required to actually execute it, it's brutal. How do you sleep at night with 50% of your net worth tied up in one single stock? Think about your average retail investor. They might go into total panic mode if a position that makes up just 5% of their portfolio takes a 20% dip. The anxiety is paralyzing. Yet here we have a billionaire casually riding the market waves with half his capital anchored to one ticker symbol. So how does he do it? His secret weapon is absolute conviction. Duan doesn't mitigate risk by spreading his capital incredibly thin across hundreds of average ideas. Instead, he mitigates risk through a profound, unshakable understanding of a single company's intrinsic value and its competitive advantage. If you truly know exactly what a business is fundamentally worth, a sudden drop in the stock price isn't a terrifying, sleep-destroying risk. It's simply a temporary mispricing by the market. And it creates this truly beautiful paradox. Duan's portfolio is wildly aggressive in its structural concentration, sure, but look at what he actually owns. Apple, Berkshire Hathaway, Alphabet, global leaders in energy like Occidental Petroleum, and massive e-commerce plays. He's incredibly conservative in the quality of the businesses he chooses to buy. He basically constructs a hyper-aggressive vehicle, but he only fills it with the safest, highest quality assets in the world. Which leaves us with this final, somewhat uncomfortable question to ponder as we wrap up this explainer. Look at your own strategy and your own portfolio. Are you diversifying to actually protect your wealth? Or, as Duan Yongping might suggest, are you simply using diversification to hide a lack of conviction? It's a fascinating lens through which to view the market. Thanks for joining me today, and I really hope this deep dive into extreme concentration gives you a whole new perspective on how you assess risk, value, and your own investment mindset.